Well, hello, everybody, and thanks for coming out. Before we delve into our presentation, let's warm up with a little tax brain teaser about our friend Bill. Sounds like fun now. So, after working hard for his adult life, Bill, 65, is finally retired and is attending more concerts than ever before. Bill has $48,988 in taxable income, which includes $37,500 in Social Security benefits. As you can see, Bill's 48,988 of taxable income puts him in the 22% tax bracket because it's more than 47,151 and less than 100,525. Towards the end of the year, Bill decides to take $1,000 out of his IRA for a trip to see Willie Nelson play in Austin, Texas. How much is he taxed on the additional $1,000? Well, the logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax or a 22% tax chipper. Simple enough, right? Wrong. He owes 1% federal tax rate on that income. Thanks to the madness that's our tax code and the unique formula in determining how Social Security benefits are taxed, Bill owes $407 in that extra income. Shocking, right? Almost to the point where you can't possibly believe that it's true. If the top rate for the single taxpayer is 37%, which doesn't begin until he has more than $510,000 in taxable income, how can he pay a higher tax rate with much less income? Well, it doesn't make much sense. But here's the thing. It doesn't have to. It's the tax code after all. Later, I'll explain more on why Bill faces the tax bill, but for now, it's vital to remember that when it comes to taxes, the obvious answer isn't always the correct one. Well, welcome to our presentation, How Tax Planning Changes Through the Four Stages of Retirement. For those who've been with us before, welcome back. My name is Tim Gardner, and I'm a wealth manager with Chatham Retirement Partners, and I thank you for joining me to learn more about taxes in retirement. Now, I want to assure you one thing about this presentation. After listening to this talk, you'll be better informed about the challenges of retirement tax planning. Now, I know you're wondering, why is Tim giving a presentation about retirement tax planning? Well, occasionally, I present workshops and classes on various financial education topics such as Social Security planning, retirement planning, IRA, healthcare planning, cybersecurity, and even some late-stage college planning, among other things. My goal is to inform and educate my audience so you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen people make mistakes and pay more taxes in retirement than is necessary. When that happens, it actually makes my job harder because we have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem like a complex and jargon-filled item, though the underlying concepts are fairly straightforward. So, let me take a second to explain how this workshop will unfold. The presentation is organized into 4 keys. Each key builds upon the previous one to form a solution to our presentation problem, as you'll see. To help you remember what we're covering, I've included an article, How Tax Planning Changes During the 4 Stages of Retirement, down in the chat. This article summarizes the presentation so you can follow along today or review it later. Now, at the end of the presentation, I'll invite you to a tax and retirement planning overview meeting. This is a complimentary one-on-one meeting I offer so we can discuss the issues raised in today's presentation in private. I'll tell you more about that one later. I also want to assure you that this is not a sales presentation. You will hear nothing. What you will hear is nothing like a sales presentation. What we will review tonight is on the agenda, which is linked below. But now, there is one other important point I need to make. Everyone's tax situation is different, and you should always consult a qualified professional tax advisor to discuss your specific situation, especially about these topics, such as traditional IRAs, which are tax deferred. You must pay taxes on distributions or conversions at ordinary federal or state tax rates. Roth IRAs, which are non-deductible. Money in a Roth grows tax-free, and the earnings may be withdrawn for tax-free under the IRS rules. State taxes. This presentation references federal taxes, and you may face state taxes depending upon where you live. So check with your tax professional. So again, I do not provide tax advice. What I do provide is I help people understand the tax code through tax planning, how other rules could impact their financial planning and investments. Then we develop a plan to consider the many odd things that people encounter, especially around taxes and retirement. Now, we hope you understand the distribution game. The spending of assets in retirement differs significantly from the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades now. You've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in a different distribution phase. This phase has new and strange rules that can catch people off guard. Along with those new rules, there are often many changes in your life that can significantly impact your taxes too. For instance, your children are grown, meaning no more child tax credits. Your house may be paid off, meaning no more mortgage interest deductions. And you may no longer receive tax-free employer-paid medical insurance if you've already retired. If you've stopped working, you may no longer be able to stash money or your income into a 401k or similar plan to manage your annual tax bill. And at some point, you'll need to start taking Social Security. Sooner or later, when you're 73, you'll have to start taking required distributions from your retirement accounts. And the list goes on, and it changes constantly. Many aspects of retirement affect your tax bill differently from your working years. Understanding these and how they impact you is crucial. At this point, you may be thinking, so what's the first thing I need to understand about retirement and taxes? Well, this brings us to our first key. You must know your after-tax retirement picture before retiring, because a $500,000 401k or IRA balance isn't $500,000. The government claims part of that money because the taxes have been deferred. They'll get their share when you're forced to start taking required minimum distributions. Now, the Secure Act 2.0 pushed back RMDs to 73 if you were born between 51 and 59. If you were born after that, you won't have to start taking RMDs until you turn 75. Obviously, the higher the tax rate, the less your account will be worth. Here's an example. This chart shows the accumulation of an after-tax accounts you could expect to receive from a $500,000 IRA earning 6% a year at various tax rates. As you can see, the lower your tax rate, the more you keep. Simple in theory. This presentation applies to pre-retirees and retirees as well, so don't worry if you haven't already started retirement. Tax planning is essential throughout your retirement. Now, as a quick disclosure at the bottom, you need to note that the illustration is hypothetical and assumes a 6% rate of return. This does not represent performance of any investment product, and the results may vary. Ordinary income taxes will apply to withdrawals from the tax-deferred investment. The investor should consider current and anticipated investment horizons and income tax brackets when making investment decisions. You may think to yourself, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay for my healthcare costs. One thing you must understand before creating your retirement tax strategy is Social Security and Medicare also have their tax traps to plan for. Let's start off with Social Security and taxes. Let's go back to our friend Bill from our tax brain teaser. We want to understand why he paid such high tax on the extra money he took out of his IRA just to go to a concert. Now remember, Bill has $40,000 of IRA income, part of his adjusted gross income of $65,538. He also has $37,500 in Social Security benefits, again, putting him squarely in the 22% tax bracket, and he takes the standard deduction. Yet, When he took that extra $1,000 distribution, he got hit with nearly a 41% marginal tax rate, $407 on that $1,000. Let's break that down and see how that happened. First, let's remember that the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA, and you'll see that in the after concert trip column. He has $41,000 in income. You'll see here that adding the additional $1,000 in income actually increases his taxable income by $1,850. That means for every dollar of income he received, he's being taxed $1.85. Well, here's the deal. Depending upon your income, the amount of taxable Social Security benefits varies. For instance, if your other income is low enough, all your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits may be taxable at your rate. Bill finds himself in the latter scenario. His current income after the trip, for every dollar he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he adds an additional taxable Social Security benefits. If you add it all up, $1.85 is taxable as 22% rate for every dollar of additional IRA income he receives. If you do the math, that comes to a 40.7 real tax rate on an extra $1,000. That's the so-called Social Security tax torpedo. It can impact single filers and married couples, even of reasonable to modest means during their retirement stage. It's one reason why planning for taxes in retirement is essential. Let's look at Medicare and taxes. Now, let's look at how Medicare and something called IRMA can impact some couples in the go-go years and beyond. First, what is IRMA? Well, it stands for Income-Related Monthly Adjusted Amount. The emphasis is on income. It's a monthly tiered surcharge, again, a tax, tacked onto people's Medicare Parts B and D. But it only happens if you have income over $103,000 for single filers and $206,000 for married couples if you're filing jointly. Let's take a look at what this means in action. Let's meet George and Martha. They're a high-earning married couple who both have Medicare Part B and D. IRMA surcharges affect their income for 2 years prior, and this couple is on track for a $3,222 modified adjusted income, or MAGI, for 22. Well, on December 1st of 22, George decided to sell a stock he bought for $10,000 on July 1st of 2007. He sold the stock for $11,000, resulting in a $1,000 gain that was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total tax bill of 18.8%. Now, keep in mind that 3.8% net investment income surtax is a tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So, George and Martha owe $188 in tax on the gain from their stock sale, or about an 18.8% tax rate of the $1,000. Or do they? Keep in mind, my definition of a tax is a cost that increases when your income increases. So, George and Martha will owe more than $188 because the gain on the stock sale pushed them off the IRMA cliff and into paying a higher Medicare premium. Let's take a look. At this point, Part B IRMA chart, the extra $1,000 pushed their AGI into the next premium tier, which starts at $322,001. So now, instead of owing $349.40 each for their monthly Medicare Part B premiums, George and Martha owe $454.20 per month, an extra $104.80 per month, times 2, $209.60, for an annual total additional income related monthly adjusted Medicare B premium of $2,515. But it's not over, because Medicare Part D IRMA charges are also impacted. Georgia and Martha will each pay an additional $20.50 a month for their drug plans, an extra $492 for the couple over the year. Adding all the IRMA surcharges together, Georgia and Martha will each have an additional $125.30 per month, or more than $3,000 in combined charges for this year. Now, combine that with $188 of actual federal tax they would owe on their stock sale, and the total tax owed on that $1,000 gain is $3,195.20. That is a tax rate of 319.5%. Let's do a quick review. They sold the stock for $1,000 income gain. The stock sale gain was taxed at $188, or 15% long-term capital gains and 3.8% of net investment income for high earners, for a total of 18.8%. The extra income for the stock sale triggers new IRMA tiers. The total IRMA surcharges amount for the year to $3,007.20 for George and Martha. So that extra $1,000 in income triggers $3,195.20, a 319.5 real tax rate. So you can see being pushed into the higher Medicare Part B and D premium ranges is worse than being pushed into a higher marginal tax bracket. That's because if you exceed the regular tax bracket by even a single dollar, only that last dollar is taxed at the highest rate. But if you go over the Medicare Part B and D income levels, even by a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's why it's called the IRMA cliff. Remember that your IRMA payments aren't determined by how much you made the previous year, but what your MAGI was 2 years ago. This is another tax issue that catches a lot of people by surprise and needs planning. Ensuring you enroll in Medicare at the right time is also a crucial decision. If you mishandle it, you could get hit by a lifelong penalty. To help you understand, let's meet Jim and Ann retired at 65 and Ann retired at 66. Before Ann's retirement, the couple had health insurance through Ann's employer, which they continued after Ann retired because her employer offered retiree health benefits. Unfortunately, they didn't know they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers health care insurance benefits, those are generally paid second to Medicare after retirement. But Jim and Ann only realized that mistake once it was too late. Thanks to the way Medicare enrollment periods work, they couldn't begin coverage until the next year. Worst case scenario is they might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in the best case scenario, Jim and Ann missed their deadline to sign up for Medicare Part B, and they each owe a 10% Medicare Part B premium penalty for life. As you can see, much that translates into real dollars. They owe $420 extra in 24, and historically, we can estimate that premiums will be higher, so that 10% penalty will only grow and grow. So, for a lifetime, that could translate into a $10,000 mistake for the couple. Now, for simplicity's sake, we're going to assume that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that too if you miss it. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So, if you're like some other people who've seen this presentation, you may be asking yourself, are there any other traps I will face in retirement? Well, the rest of what we cover isn't like what we've seen with Social Security tax torpedo and the Medicare IRMA cliff. The public generally is not aware of those tax squeezes. We'll see how the tax code in plain view snags retirees, especially those when there's no planning. And that brings us to our third key. You must know how and when to use your taxable, tax-deferred, and tax-free assets to efficiently manage your income and tax brackets. You can't haphazardly tap into your tax-deferred accounts. Timing is everything, and if you don't plan carefully, you'll encounter unintended tax consequences throughout retirement. One way to help manage your income before and during retirement is to utilize a Roth IRA conversion. Roth IRA conversions is a simple process that allows you to move money from a pre-tax account like a 401k or an IRA to a Roth IRA. The amount you convert will be added to your annual income and will be taxed at your rate. Say, for example, Jill wants to convert $100,000 from her IRA to a Roth IRA. She must add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that you consult with your tax professional before making any conversion. Filling up the bucket. Conversion doesn't need to be an all or nothing, though. One helpful conversion approach is called filling up the bucket. Often, you may find yourself in the middle of one tax bracket with room to add more income without pushing yourself into a higher tax bracket. For example, in 2004, the 22% tax bracket for a married couple filing jointly goes from $94,301 to about $201,050. If you file jointly and your taxable income is, say, $110,000, you'd be able to add another $90,000 without entering the next tax bracket, making your Roth conversion seem a lot more sensible. If you plan to convert a large IRA, this approach is often more tax efficient than doing the total amount all in one year. Instead, you can make smaller Roth conversions over several years, filling up your buckets each time. This can help reduce the average tax rate you'll pay on your converted money and spread the tax bill over a more extended period. Some tactics you could use in managing your income around tax brackets might include withdrawing tax-free money from a life insurance policy to keep your income low, selling highly appreciated stock for low or no capital gains, making distributions from IRAs or 401ks to take advantage of lower tax rates. And as we've seen, you can also consider a partial Roth conversion to help fill up your tax brackets. There are also two other pre-retirement strategies to consider, but they don't apply to everyone. The first concerns how you use your health savings account. This applies to people who are covered by a high deductible health plan or HDHP. The second has to do with small business owners. For those who want to be extra tax savvy in saving for retirement, can fund a company pension plan, which for sure will increase your ability for a high earning business owner to claim qualified business income deduction, QBI. Both of these tax features could help you manage your tax exposure and provide significant tax favored benefits throughout retirement. If either or both of these apply to you, make a note of it and we'll evaluate it when we discuss it later. Now, throughout our conversation, we've seen the importance of managing our taxable or tax deferred accounts, because at some point you'll be forced to take out required minimum distributions, and that can be troublesome for your tax bill. However, many people donate to their favorite nonprofits in annual gifting. So let's look at how an RMD and charitable giving may work for you with some planning. Meet Albert and Shirley. They're in the 24% tax bracket. The standard deduction for a married couple filing a joint return for 2024 is $29,200. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2024 to roughly $32,300. This means they'll receive no tax benefit from any itemized deduction unless their total exceeds $32,300. So if Albert and Shirley have $15,000 in existing itemized deductions, say from state or local taxes, deductible medical expenses, mortgage, and interest, what happens tax-wise if they still donate $5,000 to charity? Well, they get no federal tax benefit from making that charitable contribution because it doesn't exceed the $32,350 standard deduction. Now, that's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. Now, if you're over 70 and a half and have an IRA or inherited IRA, there's another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QDC for short. Let me explain how it works so you can see why the QDC can be so powerful. First, some rules. If you're over 70 and a half, you can make a qualified charitable contribution of up to $100,000 per year from your IRA. If you're married and both you and your spouse or partner are 70 and a half, and you both have IRAs, you both can make $100,000 qualified charitable contributions from your IRAs. Second, any qualified charitable distributions you make count towards satisfying your required minimum distribution for the year, which begins at 72. However, when you take the distribution from your IRA, it must go directly from your IRA to the qualified charity, or you can receive the check from your IRA custodian that is payable to the charity. Third, now this is the odd part. Even though you gave to charity, you get no income tax deduction. So, why am I suggesting a strategy where there is no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from your IRA is never counted as income when you complete your taxes. Let's see how this helps Albert and Shirley. First, suppose Albert and Shirley do what many retirees do. Albert takes the required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. He's done with his RMD for the year. Now, being a charitable person, he donates the $5,000 to charity, and the charity receives $5,000. Everybody understands that, right? But let's look more closely. By giving to charity this way, Albert and Shirley's $5,000 of charitable contribution will cost them $6,200. Why is that? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24 times 5,000 equals 1,200. So that $1,200 of additional tax Albert and Shirley must pay when they file their taxes means the total cost of the charitable is $5,000 plus $1,200 or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift was just added to their income. Yeah, that's an ouch. Now, let's see what happens if Albert and Shirley use a QCD to donate their $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his custodian transfer the $5,000 RMD directly from his IRA to the charity. This satisfies Albert's yearly RMD because he's over 72. The charity is in the same position as before. They received a $5,000 donation, and that's a good day. Albert and Shirley, however, are in a better position. They still gave $5,000 to charity. Even though they received no deduction for the contribution, their RMD distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give $5,000 to charity is $5,000. A $1,200 savings over the previous example simply by knowing how to use the tax rules to their advantage. And they did it all without ever getting a deduction. How does retirement tax planning figure in? We all know charity starts at home, but it's natural to ask, how does retirement tax planning figure into this? It's a good question because the government still wants its share, those tax-deferred assets when you pass away. As we've seen, how you set up things matters, and this leads us to our final and fourth key. Organize your assets for your family's benefit. Yes, estate planning still matters. Okay, enough about death. Let's talk about long-term care. Believe it or not, several tax breaks are associated with long-term care insurance. Long-term care premiums may be deductible medical expense at the federal level and possibly eligible for a deduction or credits at the state level. On the other hand, if you are receiving long-term care benefits, those benefits are tax-free in many cases. For instance, benefits received from a reimbursement-style policy are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or the IRS daily limit of $410. Choosing how you pay for your long-term care costs can greatly impact your estate and your heirs. In recent years, traditional long-term care policies that blend some long-term care insurance with life insurance have become very popular. Often, the insured's first inclination is to tap into a policy to pay the long-term care costs, but that's often a tax mistake. Let's look at Florence. She's widowed, qualifies for a long-term care. Her yearly care costs are about $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but not her long-term care. She also has a $400,000 IRA and a life insurance policy with a long-term care rider who will pay Florence $500,000 or pay $500,000 to Florence's children, upon her death. Alternatively, Florence could use up to $10,000 monthly for her long-term care costs. Any amounts used for long-term care will reduce her life insurance death benefit. Keep in mind, this is just an example. It does not represent any specific policy, but many term/life insurance hybrid policies work this way. Suppose Florence is infirm for 5 years and uses her term policy to pay for long-term care expenses. That's why she bought it anyway. Here, Florence pays little or no income tax during the period because she'll have a large reimbursement in her medical expense deductions. The $500,000 policy pays out $300,000 or $60,000 annually for 5 years. That means her kids will inherit tax-free insurance of $200,000 and the remainder of her $500,000 policy value. In addition, her children will receive $400,000 in her IRA, which will be taxable. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care and expenses instead. Because of her high medical expense deductions, Florence still pays the minimum annual income tax. Now, the kids will inherit the $500,000 life insurance policy completely free of tax and roughly $100,000 remaining in her IRA, which may be taxable. Comparing these scenarios, the ultimate benefit is unknown because it depends upon Florence's children's tax rate. But it's hard to me to imagine a scenario when paying for long-term care with her $300,000 taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 in tax-free money. In the second scenario, we're preserving tax-free money for her heirs and paying for her long-term care with taxable IRA money. Okay, we're getting towards the end here. I need a sip of water. And you're probably thinking, goodness, how in the world are we ever going to manage all this? That's a really good question. Let's start to bring this all together. We started with a clear statement about our problem. Retirees often pay more taxes than expected because the confusing system treats various income types differently and contains hidden taxes and penalties. Let's do a quick review of what we've learned about the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding your savings after tax value before retirement. We also saw that those pre-retirement years were critical to considering your tax-deferred savings and start taking advantage of funding Roth accounts to fill up your buckets, something you do through the early retirement years in low tax years. We also looked at Social Security taxes. Medicare has its own tax-like structure that can push you off the IRMA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those go-go years. Because starting in the middle of your retirement years, you'll be confronted with required minimum distributions. And we've seen the importance of planning your income for needs before then and with the tax issues that are involved with it. Then we saw the importance of setting up your assets in a way and managing them in your later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All these items together lead us to an obvious solution to our original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap into assets to cover your expenses. Understand the range of taxes you will face at the various stages and manage your actions so you pay as low a tax rate as possible. Attending this presentation indicates you're preparing to leave the accumulation phase, the savings phase, and move into the distribution phase when you're starting to spend your retirement assets. And we've seen that the distribution phase is far more complicated than working and collecting a paycheck. And managing your taxes through the 4 stages of retirement is a part challenging the retirement plan. We've seen the cost of mistakes. Naturally, we want to be efficient in our savings, and there are strategies to reduce our tax burden. But with many things in life, this takes education, planning, and advice. And it is a lot to think about. Our tax code is complex, and the rules keep changing and keep changing again. But what stays the same is a need for a plan. I'd like to help you create your retirement tax planning strategy. I've put a link down below so you can schedule a meeting at a convenient time for you. This is a complimentary 1-hour service that we offer. My regular rate is about $250 an hour. So during this meeting, we'll assess you and your family's current position regarding retirement preparation, review your retirement timeline, and identify key retirement planning and tax issues you may need to anticipate. After that meeting, we can act as a resource to help you find the right people to assist you with specific tax advice if needed. And we can help you with critical financial planning and investment advice related to your situation. Regardless, when you leave our meeting, you'll be better informed about your retirement planning needs and what to consider doing next. We want you to be prepared and organized for this aspect of your life so that you and your family can have a peace of mind knowing that you've got a plan and they're making the most of your retirement accounts. Now, after the meeting, I'll be sending an excellent resource on the topic called Our Guide to Taxes and Your Retirement. And with that, I would like to open it up for questions.